Good evening, everybody, and thank you for joining us here in this month's edition of the monthly market webinar. As usual, we'll be covering the markets, the economy, and many of you have, of course, already sent in your questions in advance. So we'll try and cover some of those questions as well. Also, on today's webinar, as in past episodes, we'll have one of our fund managers joining us. So today I'm delighted to have on the webinar today Swati Kulkarni, long-time fund manager at UTI Asset Management. She's of course been stewarding UTI Mastershare for over 15 years now, and she also manages UTI's MNC fund and UTI's dividend yield fund. But she will be taking you through a presentation on UTI Mastershare, which I'm delighted to announce was recently also the winner of an industry award. So that's going to be the session for today, the usual market wrap-up, followed by a discussion on UTI Mastershare and how we approach large cap investing, which will be taken by Swati. And of course, today we'll also have Niranjan, as usual, from our product team, who will be, pulling up the presentation on the screen. So without any further ado, I'll just request Niranjan to get the presentation up there. Yep, so that's me and Swati who's going to be talking today. Yeah, we can just move on to the first slide, Niranjan. So this is a wrap of what we're going to be covering: equity markets, Mastershare, and then Q&A. Yeah, next slide. So straight away, we'll just dive into, I think what is very, very topical at this point of time, which is to say the earnings trend for the Nifty. As you're aware, we are about to start the earnings for the Nifty reporting season. For the financial year FY22. So, one large company has already reported results yesterday, and the rest will commence over the next 4 to 6 weeks. As you remember, there's a very high bar for earnings estimate in FY22, almost 35-37% earnings growth estimated. It does appear that we are pretty much in line to deliver that kind of growth, because when we look at the ask rate from the fourth quarter, it does not appear to be so much of a challenge based on the estimates that we are seeing. So it's going to be a remarkable 2-year period for Nifty EPS. Remember, when you look at the Nifty EPS here on the slide, you can see that the average was running at less than, just about 6% for quite a few years, right? The CAGR all the way from 2008 to 21 runs at only a 6% CAGR, and now suddenly in the current year we have 37% earnings growth estimated, which is a big jump, followed by a subsequent 19% earnings estimate in calendar 23, and we'll also talk about how realistic those growth estimates are. So moving on from that to the next slide. Yeah, so here you can see the trend in terms of the earnings estimates for each of these financial years. The yellow line shows you the earnings estimates for the year ended March 22. As you can see, it has been largely consistent over the past, I would say, 6 months, with a slight downdraft in recent weeks, perhaps as analysts readjusted their earnings estimates for the year. So slight downdraft. Similarly, you can also see the 23 estimates, slight downdraft, but actually the trajectory has continued to move up for FY23 earnings over the last 6 months. So slight downgrade, but at this point of time, it doesn't look like analysts have really cut their earnings estimate on account of some of the recent factors. One is, of course, the tightening that's happening of monetary policy, though I would say that has been reasonably well telegraphed. The bigger risk to earnings estimates might actually come from the fact that the conflict in Russia-Ukraine has led to a sharp spike in commodity prices, and we'll talk about that later, and that's potentially a risk to earnings estimates in 23. But this is the numbers as we speak, and we'll know how likely it is that these numbers are going to be achieved, as I said, in the next 6 to 8 weeks. So moving on from that, To the next slide. I mentioned this, right? And this is really remarkable. If you look at the left-hand side chart, this is the trend in the Bloomberg Commodity Index. You can see over there, after peaking in 2010, 2011, the Bloomberg Commodity Index continued to decline, and it made a low sometime in March 20, which is true for many things. But look at the subsequent recovery. It not only recovered to its pre-pandemic level, but has actually gone to levels that we have not seen since almost 2014. So this is a record multi-year high for many commodity prices. And in fact, many commodity prices are now at lifetime highs, right? Your
Hang on, there seems to be some network issue.
Yeah, sorry, I think we encountered a bit of a internet interruption over there, so sorry about that. But as I was commenting, if you look at this slide, which is up on the screen right now, on the right-hand side is the FAO Food Index. And as you can see over there, even food prices have surged to a multi-year high. In fact, this is the highest food prices that we are seeing going all the way back to 2010, 2011. And the reason for this is fairly straightforward. If you look at Russia, Ukraine, they are a very significant part of the global food supply chain, commodities like wheat, corn, edible oils, and therefore this disruption has caused a strong surge in food prices. Now, what's the implication of these two? If you look at the next slide, then I'll give you what my context of the issue is in terms of this run-up in commodity prices. First of all, as far as food prices are concerned, this is a concern if you can just go back to the previous slide on EBITDA margins. Yeah. So first of all, as far as the increase in food prices is concerned, this will create a problem for many economies which are net importers of food grains. Now, thankfully, this is not so much of a problem for India because India is reasonably self-sufficient in food grains and agricultural commodities except for edible oils. And also, we are currently running excess stock as far as most food grains are concerned. So on balance, India might actually be a net beneficiary of the run-up in food prices, though this could mean some pressure in terms of MSP and also therefore eventually in the food subsidy, but that could be perhaps more than a year away, because as I said, we actually have sufficient stock at this point of time. The bigger challenge in terms of this inflation spike is actually the risk to margins. Now, if you look at this chart, it shows you the trend in the Nifty EBITDA margins going back over the last 4.5 years, and you can see that the EBITDA margins for the Nifty were in about the 17 to 18% range, all the way up to the pre-pandemic period. And then when the pandemic hit, because a lot of the commodity prices collapsed, we actually saw a very sharp expansion in EBITDA margins for the Nifty 50, margins moving up to about 20%, which is a record high that we have not seen for many years. And this was driven by the collapse in commodity prices. Now that the commodity prices have rallied to multi-year highs, it does raise the prospect of mean reversion in margins. Now, of course, not all companies and not all sectors will benefit or suffer equally. You could witness a situation in which the commodity producers could benefit and expand margins, but companies which are commodity users, so they purchase steel, oil, energy in their commodity mix to make their end products, these are the companies which might actually suffer from margin compression. But in a way, what has happened recently with this commodity price spike to multi-year highs is that it may offset the benefits that we saw in the immediate post-pandemic period and could lead to some reversion in margins. And any reversion in margins at a aggregate level could then also pose a challenge to the forecasted earnings growth for the year ended March 23. So this is something that we would have to worry about at this point of time. Moving on from this, I'll just quickly run through our normal valuation slides. I think we had already highlighted this when we spoke in March. So if you go to the next slide, which shows you the Nifty PE multiple on the left-hand side on a trailing basis, you can see that the Nifty PE multiple on a trailing basis is still within the fair value zone. On a forward basis, it did come within fair value, but with the recent rally through the month of March and early April, it sort of climbed back into slightly expensive territory. But I would still say that large cap valuations are somewhere between fair value to slight, mildly rich territory. So still in a zone where I would still describe as being reasonably valued. If you move to the next slide, this is a view of valuations based on price to book. Now, very clearly over here, you can see that valuations are in very rich territory compared to our past history. But I would say that there is one caveat here. The caveat is on the right-hand side, which is return on equity. If you see the return on equity of the Nifty 50, this is a multi-year high. This is the highest we have seen return on equity going back all the way to 2014. So yes, the price to book is elevated, but perhaps we have to look at it in the context of ROE, which is pretty much among the best that we have seen and still continuing to demonstrate some potential for further increases. On the next slide, we've got the price to book for the mid cap and the small cap. Not much to say here except to say that on a relative basis, and I'll have a slide on this later, mid caps and small caps still are slightly pricey as compared to the large caps where we have a little bit more comfort. Moving on to the next slide. This is a comparison of how do equities compare to bonds. Now, remember, as I keep saying, in the previous slides, we have looked at equities relative to their own past history. And over there, we can see large caps, sort of fair value, mid cap, small caps, not so attractive. Here we are comparing equities to the alternative asset class, which is bonds. Now, because the 10-year bond has sold off quite sharply in the past few days, reaching almost 7.15%, the yield differential between equities and bonds is actually now very much against equities and in favor of bonds. So from an asset allocation point of view, it must be said that the argument is not favorable for equities. Moving on to the next slide, which is the last one on valuation. This is a comparison of Nifty 50 vis-a-vis mid caps. Broadly telling you the same story that I described earlier. You can see those gray area at the bottom suggests that the Nifty is actually at a discount to the mid-cap index. And this is a much higher discount than average. So at this point of time, the large caps are actually more attractive than the mid caps, as I had pointed out earlier. So finally, to come to the final slide of my section, I think we've made these points earlier. India's growth in a global context is still impressive. The trendline trajectory, 6.5%, is the highest for any major large economy in the world. Remember that this year, China is actually talking of 5.5%. And if you see most independent forecasts, they're actually closer to 4% or thereabouts. Inflation, certainly a challenge in India, but a much bigger challenge, I would argue, in other countries, particularly Europe and in the US. Normalization of policy has commenced, as we saw in this week's monetary policy. We can take comfort from the size of foreign exchange reserves, $600 billion, just under 12 months of imports, and the current account deficit at 1.5%, even accounting for the current surge in commodity prices. We don't think this should cause the CAD to go significantly above 2.5%. Corporate India has significantly deleveraged. I talked about the profit boom of the last 2 years, so that has helped them deleverage, and the credit cycle was also supportive because credit to GDP has declined. Capacity utilization still underwhelming. So to that extent, the heavy lifting on capex has to be done by the government. I don't think the private sector is as yet ready to significantly lead private investment, and therefore we'll have to be patient on that front. There is some risk to earnings because of higher inflation and rates. As I pointed out earlier, there is a potential risk of mean reversion in margins, which could impact earnings estimates. Valuations have edged higher, but at least for the large caps, they're still somewhere between fair value and the mildly expensive zone. So that's about it for the context that I wanted to provide today on where we are in the markets. We've now talked about large cap valuations, and I can't think of any better segue than this to invite my colleague Swati Kulkarni, the fund manager, as I said, of over 15 years with a stellar track record for UTI Mastershare, and I'll hand over to her to run you through how she manages this particular fund. Over to you, Swati.
Yeah, thank you, Vetri. As the brief that Vetri gave, Mastershare is a large cap fund, and the way we manage this fund, we follow principles of growth at reasonable price, and have a blend of growth and value in this fund. We typically take top-down approach to decide the sector active weights, and then look at bottom-up while selecting the stocks. As the category is mandated to invest about 80%, at least 80% in the top 100 stocks, Mastershare also has followed this, and currently we have 87% of the portfolio invested in top 100 stocks. In terms of market capitalization, we typically avoid sector concentration and also concentration of top 10 holdings, and the internal limits for the same are lower of 35% or benchmark weight for the sector plus 12%. And top 10 stocks are limited to about 55%. I'll also spend some time about how exactly we are selecting stocks, and you will realize that because we are looking at sustainable competitive advantages, which gives us conviction to hold the stocks for a much longer time in the portfolio, which gets reflected in the lower churn of the portfolio or the portfolio turnover ratio versus the peer group. So the investment approach that we follow is growth at reasonable price. What is the underlying expected earnings growth, and what is the reasonable price that we need to pay for while owning a stock? Now, as you know, some businesses are steady growing businesses where the valuations in current times may look expensive, but the underlying growth may make it the returns which could come as a compounded, compounded returns, because the return ratios could be superior. And even if the multiple remains high, the underlying growth itself would be actually resulting into market capitalization growing for that company. I have an example for that. And this, secondly, there could be cyclical businesses or businesses which are currently going through bad phase, but have those competitive advantages, which gives us conviction to bet on these businesses and to own these businesses, because we think as the cycle turns, these businesses are likely to do better. They could see improvement in the earnings, and market often prices such kind of businesses pessimistically when the news flow around it is negative. So competitive franchise is very important for us. Our preference is clearly seen in the names that we own in the portfolio. When it comes to competitive franchise, we look for in B2C sectors particularly, where the business is directly, dealing with the consumers, we look for the evidence of pricing power. And in B2B segments, we look for cost efficiencies, because the buyer is also equally strong and he'll be most probably negotiating hard. So therefore, pricing power will be absent in such kind of businesses. But how well the business is able to perform in terms of capital efficiency or cost efficiency gives them that advantage. And often we have seen that the financials of such businesses with strong competitive franchise stand out because of the kind of consistent cash flow generation, the high ROCs, low debt, so capital structures are pretty much very tight and effective, and the profitability focus is also very much observed. So that's about it in terms of the broad approach that following. And I think a few of the examples in following slides will give you a peep into how exactly we are constructing portfolio for UTI Mastershare. So here is one example of a retail private sector bank. You can see in the table that how this is the data for last 23 years. And this company has been very much focused on the low cost. So the sources of funds has been through the current account and savings deposits that dominates. Currently, it is about 46%. The net interest margin is therefore is managed in a very tight band, because the cost of funds has remained very superior versus the industry. Also, there is a cost control that you can see that operating cost to income ratio has also been at 36%. And in addition to that, this bank has been a gold standard as far as the appraisal standards are concerned, and therefore that reflected into much lower credit cost for the bank. And all this resulted into superior return on assets. And you can see the last line, which is the profit growth. This bank has experienced 31% CAGR over last 23 years. So this is one example which, I can say that the valuation always looked expensive to about 3.5 time books when certain PSU banks were available closer to 1 time book. But because the profits were growing at 31%, that means the book was accreting at that percentage the much better percentage than the other banks. And this sustainable growth has actually contributed the return that this company has reported. And I'll tell you that last 20 years, this company has grown at 67 times. So that's the kind of multi-bagger returns that this company could give because of the competitive advantage that they have been focusing on, and that's the kind of return that it has resulted into. Next example is on again a bank, private sector bank, but dominated by the corporate finance book. And as you know, in 2018, when the asset quality issues surfaced, particularly from the project finance book, this company also had high credit cost. The difference was that they've been transparent about it, and there were no adverse observation as far as the disclosure of this issue about asset quality was concerned. But there was a negative news around the top management. what we look through, and typically, when the company has strong competitive advantage, it is very rare to find valuations being cheap. Here, because of the negative news around the sector as well as the specific aspects about the management, what we looked through this noise was that this company had a very high current account and savings account balance, which gave them an advantage of low cost of funds. Their capital adequacy was strong, and their ROE is also sustained during this period through the disinvestment that they had of the subsidiaries. Now, this company was available at closer to 5 times price to pre-provisioning profit, which was at a much discount to the competitive banks at that time. So it gives us a comfort to own despite the negative news around, when the valuation is also favorable. Next, please. So here is another example from a passenger vehicle manufacturer. Now, distribution advantage, the market reach was definitely an advantage, but this company also had superior profitability and cash flow generation versus the number 2 player. And despite not having major launches, and because of the pandemic, the launches were delayed, this company actually showed a flat kind of performance as far as the volume CAGR is concerned, whereas the industry faced negative CAGR. So the advantage here is the kind of reach that this company had and the profitability focus versus the other players in the market. So let us look at some of the examples of competitive franchise in B2B sectors. Now, IT, take for example, IT. Now, when we were positive on IT as a sector, and we had a much larger active weight in 2017, the comparison that we made was on the client concentration. So you can see here the large cap names that we included in the portfolio then, and an active weight position. The top client contributed just about 4% versus this percentage being 13 to 24% for the industry peers. Similarly, the profitability focus that we saw here was much stronger versus the others, and the top 10 number was also much lower versus the other companies in the sector. So it was that what we saw is that what are the capabilities that these companies have on board in terms of the capabilities of taking on the digital transformation projects, and the client concentration that they had. In pharmaceuticals like sectors, we typically look at what has been the R&D spend, because that is the spend which gives us a future visibility as far as the future products are concerned, and what is the kind of whether the companies are climbing the value chain or not. So this is a kind of investment that is required to sustain the growth in pharmaceuticals. Now, in sectors like cement, which are capital intensive, we look at what has been the capital allocation in past. So here is a company which had much lower gross block to the capacity per ton versus the competition, and that resulted into better ROCs. So that was a thought process to look at such companies. And just to give you perspective about this particular cement company, it has given 188 times return in last 20 years, and 26 times from the peak that we saw in 2008 for the market. So again, market has given preference for companies which have been quite diligent about the capital efficiency and operational efficiency. Next, please. So I would also like to tell you about this particular thought process about competitive franchise gives us opportunity in the industries which are getting consolidated or highly consolidated. So here is example of a leading player in paints, for example. Now, clearly the pricing power is reflected into improving profitability. You can see the EBIT margins have grown from 12% in 2002 to 16.7% in 2020. Now, I have excluded the recent period because of the pandemic. Typically we have seen that there is an impact on the top line as well as the gross margins. But if you see here, despite the crude prices moving from about $26 per barrel to $54 per barrel in 2020, this company had expanded the gross margin from improving product mix, and because of the operational efficiencies and the operating leverage benefits that this company could get, the EBIT margins were actually expanded by 5%. So that's the pricing power in a consolidated industry. Secondly, when you look at industries, for example, telecom, now the entry of a new player in this industry actually saw erosion of revenue and profit pool of the industry by almost about 30%. Now, what was the consequence of this sharp correction in the revenue and profit pool was that the industry came down from 10 players to about 3+1 players. Now, here was a company with strong financials, very good spectrum availability, and the subscribers. They already were leaders in the subscriber share, but they saw again 300 basis point of improvement in last 2.5 years because they had the best balance sheet and to take on to the competition or the aggression of a new player. Now, going forward, what we saw in this particular industry is if it is getting consolidated and looking at the survival of some of the weaker players, it was quite an case to make that the tariff could rationalize. The conversion could happen from existing 2G subscriber base to 4G as India became, the data became a universal demand, and therefore it was quite natural that people who were on 2G would eventually shift to 4G, and the incumbent had already a good base of 2G subscribers. And also there was a reducing capex intensity in the sector, which means that the free cash flow generation would be just around the corner. So that was the thought process, to look out opportunities which are coming out of consolidation. And if that is the case, then who are the players which are likely to benefit? So that's the thought process that we applied while selecting some of these names. So this is the current portfolio. You can see the names on the left-hand side and the weight in the portfolio. Most of these names are again very much known to you, and you would also see that there are some of the names which are into small cap category also. And we tend to look at opportunities in mid and small cap space to the extent of 20%, which is permitted. And there we look for again the sustainable competitive advantage, and typically we are looking for much superior return ratios as far as ROCs is concerned, and the consistency of cash flow in this space. As far as the sector allocation is concerned, we are overweight on automobile, pharmaceuticals, the telecom, consumer services, and industrial manufacturing. Our IT exposure is also a slight overweight at this point of time. And the biggest underweight at this point of time is oil and gas, followed by power sector and metals. So just a brief on the important sectors in the portfolio. While financials look underweight, actually we have been overweight on the private sector banks clearly, because we see the evidence of competitive franchise in terms of the low cost source of funds, and also therefore in a rising interest scenario, these banks would have much expanding spreads, as well as the valuations we think are at reasonable prices. And there could be with normalization of economy, the credit growth is also likely to pick up. Bank balance sheets have already cleaned up. They have in fact excess provision as far as the COVID impact is concerned. And therefore this is a space where we have been constructive and adding exposure over last 6 months or so. IT, as I said, we have a neutralish or to slight overweight position because we think that the deal momentum is very strong. There isn't much urgency as far as the clients are concerned to move on to the digital platform, because customers are demanding that in order to stay competitive, they need to have this spend as a priority spend rather than a discretionary spend. And if you look at the return on capital employed, the free cash flow yields and the dividend yield that the sector has, that is really attractive, and therefore we are comfortable holding on. Though the comfort that we had from valuation for the sector, with re-rating of the sector, that comfort is no longer the same. But relatively speaking, when most of the other sectors are still under the pressure of supply chain and the EBITDA margin, as Vetri was suggesting, I think this is one sector where at least the revenue growth visibility has been strong in the near future. Consumer goods, our focus has been on the discretionary side, and we think that with aspirations and the low penetration levels for most of the goods, as well as the premiumization opportunities, are long-term catalysts for this sector. Pharmaceuticals, we have been overweight for long. It has actually worked in some times, and some on recent times we have seen that sector not doing so well. But we have taken a diversified approach as far as pharmaceutical exposure is concerned. Focus on domestic side is on the chronic therapies. We are also liking the companies with strong export opportunities, especially in complex generics and specialty pharma. And we also have an exposure to CDMO players, which is the contract manufacturing opportunities. Auto, our overweight call has still not played out as we had expected, because there hasn't been a gradual improvement as far as the component supply issues were concerned. But with, again, Russia and Ukraine war escalation, that supply concerns are again surfacing. So the focus is on the PV, because there is again penetration tailwind. We still have just about less than 3% of penetration as far as the personal cars are concerned. And we like premium motorbikes because there again the penetration is low and EV risk is lower. We have exposure to auto ancillaries as well as off-highway tire in the other auto exposure. So that's it about the overall portfolio construct and the investment philosophy that we have followed. I hope there was a good insight as far as how Mastershare portfolio is constructed. And you know that this portfolio, Vetri did mention that I have been managing for last 15 years. But if you see the long-term performance track record of the fund, and that's there in the next slide. Niranjan, can you move on to next slide? Yeah, so this chart only emphasizes the fact that mutual funds are for investors who are looking for time as their competitive edge. You can see here that despite the corrections that this chart reflects, these corrections look small now in hindsight, because the growth in the NAV has surpassed far higher than the corrections that investors would have endured during various periods of time. So that's the power of compounding, and that's the power of time that the investors in Mastershare who invested in 1986 have enjoyed. With this, I think I'll give back to Niranjan. Niranjan, for Q&A, can you just take it back?
Yeah, sure. Thanks a lot, Swati ma'am, and also Vetri for a quick update on the equity market, and Swati ma'am for the quick overview on our large cap offering UTI Mastershare scheme. So, like Vetri said, we had received a few questions beforehand, and a few of them we thought we will display on the screen and answer them. And while we do that, a quick reminder to the participants to use the chat box there available there to post your queries, and we will take the queries that you post over the next 15-20 minutes or so. So the first question for today is, this is a question, Swati, you can take this. Over the last few years, alpha generation for most of the actively managed large cap funds have been a challenge. So some of the reasons may include polarization in performance, consolidation in markets, etc. So is this trend likely to continue? If yes, what kind of expectations should investors set for a large cap fund?
Yeah, sure. So yeah, large cap funds, definitely this category has seen alpha reduction of late. Also, some of the other market caps also have seen this. But I guess this is a short-term phenomena, and if you look at the long-term performance of Mastershare, we have definitely generated alpha. We saw that in the previous chart also, that about 2% extra return over the underlying benchmark. What it means in terms of the corpus that you generate. So I would say that yes, in recent times there have been issues because the large weight index participants have performed well, where we had a view that probably the return on capital employed was not good, and the commoditized business cash flows were used in a very aggressive way to deploy in various other businesses. And that particular business could actually get a lot of funds, and the balance sheet was improved because the balance sheet otherwise also was very, very high on debt, which we thought was a risky bet. Besides that, I think even in last 1 year, there were periods most of the time on a monthly basis, or the rolling 1 year return or 3 year return, the fund was generating alpha. But yeah, in recent time, if you see March performance over 1 year, we are slightly lagging the benchmark. So if you want to see, the long-term performance, we have been including one slide, typically to show that the top performing funds typically are preferred by most of the investors because they are like easy choice. So how Mastershare has performed in last 15 years versus the top performing funds every year. Top 5 funds we have chosen, a large cap as well as the multi-cap category is what we have taken here as a sample, funds. So 10 lakhs invested in Jan 2007, when I started managing this fund, is equivalent to 51.57 lakhs, versus if someone had invested in Mastershare only, that 10 lakhs grew to about 56.8 lakhs. CAGR of 12.3%, 70 basis point higher than the top 5 funds, strategy. And it has beaten the benchmark of 11.7% return on the benchmark also. So that is what I meant, is it's equally important for us to actually look for consistency, and also, typically not avoid the mistakes which may come. So that's what has resulted in this kind of performance. There was good amount of alpha generated on the downside as well, which we have shared in past with you. So I think if you look at long term, definitely there is a case for alpha creation in large cap too. There are opportunities when market participants chases few stocks and the valuation becomes quite expensive. Similarly, as I was explaining you the corporate bank example, there are opportunities when valuations are too low because of the pessimism in the market, and I think we could get these opportunities mispricing from time to time, and showcase the past performance that we have shown in future also. Although there is no guarantee.
Sure, ma'am. Thanks for that lucid answer, ma'am. There is one question. This is a question, Vetri, you can. This is a question for you. In the face of soaring inflation and the fallout from the war in Ukraine, how are the corporates in India coping up with the rising interest rate expectations? rising commodity price and the prolonged supply chain issues?
Yeah, thanks, Niranjan. Well, in a way, I guess I already sort of answered some part of that. I think as far as interest rates are concerned, the good news is that while RBI will certainly have to normalize monetary policy, and we do see some hikes through the rest of 22 and 23, the number of hikes required at this point of India still don't look very excessive. So I think the economy will be able to tolerate that level of normalization of monetary policy, withdrawal of accommodation, and slightly higher rates. I think the bigger challenge from a profitability and growth point of view is what is happening with commodity prices, because remember, the increase in commodity prices will translate and hit the domestic economy. That too would remove money from customers' wallets, particularly in the case of higher oil prices and some other essential commodities. And as regards the other, so it reduces their spending power. And on the other hand, the increase in the prices of raw materials will cause problems for companies, because they will have to choose as to whether they are able to pass on this entire impact to consumers. And even if they do, there is potential for customers to either reduce consumption or to downtrade. Both of these are trends that we have seen in the past. I also think that there are many businesses where companies have demonstrated over time that they are able to gradually pass on price increases to their customers. But all managements have to act on this carefully, because remember, value as a shareholder is created only if you create value for customers. So, in a sense, the primary accountability to ensure that customers continue to be loyal to a customer's products means that management cannot afford to shock the customer with significant and sharp price increases, and these have to be passed on to customers over a period of time, rather than trying to manage margins on a quarterly basis. And I think that is what, as intelligent owners or as thoughtful owners, we would want good managements to do. So there is some risk to margin estimates, and to the extent that the market is pricing itself off such earnings estimates for 2023, there is some risk to margins. But as I said, I think good companies will perhaps have to absorb some of the pressure in the near term, but they have demonstrated that over the medium to long term, they are capable of passing on cost increases to customers.
Sure, thank you. One last question. This is a question to you, Swati, again. So while mid and small cap continue to trade in expensive trajectory on trailing price to book basis, what is the portfolio strategy adopted in UTI Mastershare unit scheme for their exposure and also portfolio turnover? In fact, this is a question which is also coming from our one of our online participants, Mr. Kalyanan.
Yeah, sure. So Niranjan, as I said, that we are open to look at opportunities and mid and small cap, as long as we have the evidence of competitive franchise. And we have a couple of examples to explain the point which I am saying. If you could shift to those slides. Yeah. So Jubilant Foodworks is a mid-cap idea, and this we actually were waiting for this idea to take in the portfolio, because we saw that there is clearly a lifestyle change. There's a more more number of youth coming into the working group, and there was a strong demand potential. But what we had seen was that because of the aggressive store opening, the same store growth was falling during the period of 2014 to 2017. And as you know that the margins of this business are highly levered to same store growth. And therefore we were just waiting for this company to show some signs of rationalizing their store opening, and as well as some sign of same store growth coming back. In the meanwhile, the company also was doing changes to respond to the changing customer behavior. That, like, for example, the value for money that typically the customers look for. So they moved from a single Wednesday value for money concept to entire week everyday value. And also they realized that there is a preference for home delivery, so they actually went for that convenience and how quickly they could deliver. So these were some of the changes that the new after the CEO came on board, they were making those changes. The working capital was always tightly managed, and the revenue growth, what we saw in pre-pandemic areas of like 10 years period, was in excess of 25% as far as the EBITDA growth is concerned. And revenue growth was also about 23.6%. Now, even during difficult times of pandemic, we have seen that because of the operating leverage, the variabilization of the delivery personnel, as well as the delivery charges that they started to charge the customers, we have seen margin expansion. So I think this is one idea which probably is a case where, the competitive franchise that we saw, and we were waiting to take on exposure to this, which has worked well for the fund and in the mid cap area. And I'm sure, like, if the our rational thesis is right, we could see this moving into large cap at some point of time in future. The next idea I have included is in the small cap space, just to tell you that what we are looking even in small cap, let's say. Niranjan, if you can move on to the next idea that we have included. Yeah, so here is the power exchange that there was an IPO in 2017. Now, typically Indian power market is divided between long-term PPA and short-term requirements are done through the bilateral arrangements between the Genco and the Discom companies from various states, not necessarily from the same states. So here the exchange contribution has remained quite low despite the growth of about over 17% over the last 10 years. And the percentage is still below 6% versus 35 to 50% for European markets. IEX has 90% market share. The ROEs have been more than 45%, and 96% of its net worth is in cash. So we spotted this opportunity despite being in small cap, and as you know, this particular stock also has worked well. So we would be open to look at these kind of opportunities in small cap and and mid cap space, provided they demonstrate the sustainable competitive advantage, and they have strong ROC return profile as well. And of course, needless to say, it will be limited to 20% of the overall portfolio, because that is what the mandate is for this fund.
Sure, ma'am. Thank you. We will now take a few questions which are coming online. So kindly keep posting your questions. We will take them. First question to you, Vetri. So this is on the GDP growth forecast. The GDP growth forecast for the financial year 23 is lowered to 7.2% from 7.8% by RBI in the recently concluded Monetary Policy Committee meeting. So what are the factors having a negative impact on the growth trajectory of Indian economy? If you can highlight a few on that.
Yeah, sure. Thanks, Niranjan. And also, I should just point out that, all the slides that Swati and we've used to explain to you about Mastershare refers to either past holdings or current holdings in the portfolio. None of these is a recommendation for that stock, but just using that as an example to convey to you our thought process about how we manage the strategy.
Yeah, thanks, Vetri, for clarifying that.
Yeah. So just coming to the question, I think the reasons for the cut are actually, I would say, in a sense, quite self-evident. It's the conflict in Russia, Ukraine. which has caused commodity prices to go up. That would have a negative impact on the current account deficit and on domestic consumption. So I would say a lot of those cuts are coming from that factor. Of course, it's now a function of the persistence of the conflict and the period of time that this disruption stays in place. We don't know that, so the outcome is more probabilistic. We can't really be certain as to, even that 7.2% growth rate. It's a probabilistic number. But I will just step back for a moment and remind you what I said in my presentation, which is to say that the underlying growth trajectory of the economy is more a 6.5% number. If you actually see RBI's own forecast for fiscal year 23, the 7.2% is a function of 17% growth in the first quarter. So it's a base effect. If you actually see their forecast for the third quarter and the fourth quarter of the current financial year, it drops all the way down to only about 4-5%. So the trajectory of growth we should think about is more 6%. Don't get too carried away with the headline numbers, and keep in mind that all of these are probabilistic because we don't really know how long the conflict and the disruptions will continue.
Sure. Thank you. There is one question again, you can take this. The question is like this. The growth stocks by and large have relatively struggled over the last few months as inflation rises and monetary policy tightens. So how is this likely to play out in the macroeconomic and geopolitical uncertainty space for longer term?
Sure, that's an interesting question, and I think Ajay, our head of equity, had also spoken about this and also perhaps blogged about it, and we could share that later. But very simplistically, growth stocks are being bought on the basis of their long-term growth opportunity. So you're discounting cash flows which are likely to accrue to the company 10 years, 20 years, 30 years out, arguably. And when the cost of capital goes up, because you are discounting cash flows which are so far into the future, it tends to have a disproportionate impact on the value of the stock. So it is not unusual for growth stocks to experience a bit of a setback when you start to talk about rates moving higher. But I think, the initial reaction perhaps has already captured some of that negative sentiment. And over a period of time, the market will have to readjust to not only the cost of capital, but also the potential for the company to achieve growth over a longer period of time. So I think eventually the equation will get slightly more balanced out. So what we are seeing is not unusual, which is the increase in rates leading to some underperformance in growth stocks. But given the relative valuation between value and growth, I would think we are now closer to sort of neutral territory for value versus growth, rather than there being a very clear advantage in favor of one versus the other.
Thank you, Vetri, for that apt answer. One question to you, Swati ma'am. This is on the fund. So, as a part of the strategy, the portfolio turnover ratio of UTI Mastershare unit scheme has been relatively low in the long term. So, how does the question is actually, what role does macro and cycle play in your investment approach?
So macro and investment cycle basically, I would say, plays in terms of the top-down approach that I take rather than the stock selection. So basically, it is which sectors I want to go overweight or underweight, and then after deciding that, I get into the stock selection. Now, portfolio turnover is low because the thought process that goes into selection, and as I said, that when I'm looking for sustainable competitive advantages, I'm looking for durability of such advantages, and therefore once I establish that there is a evidence of such advantages, there is no need to change or exit such names unless the rationale is when we review the portfolio, if the rationale is no longer valid, then we could take those exits. I can give you example of one private sector bank which we were holding because the bank was really showing good improvement in the CASA, as well as they had strong loan growth. But as the things changed, the NBFC fiasco happened, and thereafter we had seen their loan portfolio had not aged, And therefore, we thought that the risk for this company is increasing as far as the future asset quality issues that could come up. So we exited this stock. So that's the thought process that goes into, if we see that there is a weakening of competitive franchise, we are we are exiting such stocks. Many a times what happens is that we may not be able to do at peak of the prices, but the idea is to keep reviewing and at least avoid the mistakes as early as possible, because that also is important as in the overall performance of the fund.
Sure, ma'am. So there are quite a few questions on the sector. So there is one on IT. So this is to you, Swati ma'am. You can take this. So IT sector contributes around 8% to India's GDP, and its revenue continues to grow at like 8% from its exports. So with 100% FDI allowed in many of its verticals, so which are the areas where technology is emerging and attracting investments?
So first of all, when we talk about IT sector, it is the services, IT services. That means the clients are typically spread over the developed markets as well as some of the emerging markets. And when we talk about FDI, it could be in various sectors which are probably looking at the domestic opportunity, and that FDI money is coming in to participate in those domestic opportunities. It could be your renewables, or it could be in terms of the mobile manufacturing, or the chip manufacturing, the consumer durables manufacturing. So I think that FDI and IT services is not linked as far as the growth drivers are concerned. One is, of course, to the investment conducive environment to attract investment probably has led to much more FDIs flowing into India. You know that PLI was announced, so that the export incentives which were there earlier, they were actually clubbed into PLI, and that gave a focused approach to the sectors which could create job opportunities, and that has resulted some FDI coming back. Also, there have been cases where China plus one strategy resulted into India being looked upon as the supply hub, as an alternative to China. So FDI have flowed for that also. So it is more to do with the domestic opportunities as well as opportunities which could come up for exports in future time. And taxation is another thing which has been announced for new units, a much favorable tax regime that makes India as a competitive, in terms of the export opportunity that could be there, and that has also resulted into flows of FDI. Now, as far as IT services is concerned, I was just explaining that the opportunity came up when during the pandemic, there was a need to move the data on the cloud and to be able to function remotely during this pandemic, as world over there were intermittent lockdowns, and therefore the IT spend, which was hitherto considered as discretionary, became mandatory for the companies to stay competitive in the whole, tide which was coming for digitization, cloud migration. And Indian companies with predetermined relationship with large companies benefited out of this wave. Despite the pandemic, we had seen the large deal wins that these companies kept on reporting, and that is why we have seen the sector getting re-rated. Now, we have also seen when the growth has come back to the sector, we have seen that the attrition within the sector has gone up. People have started to move up, and in order to retain people, the salary levels have gone up. and companies have often have to resort on subcontracting. So that has started to put pressure on the margins, but the near-term revenue visibility has been strong. And I think when the growth is good, this is one problem which is easier to manage, because the top line growth has been strong for these IT services companies. So that's the thought process as far as the IT services potential is concerned.
Thanks, ma'am, for a detailed clarity on the sector. There is one question on the infrastructure. So, Vetri, this is for you. So, the residential sector continues to see demand revival with strong end user interest, aided by government impetus and incentives by developers, ensuing buoyancy. So, how are the infrastructure funds placed today to capture the upside of the sector? If you can throw some light there.
So, real estate is not really a very large part of the entire investment opportunity in the infrastructure space. And in fact, residential real estate would not fully qualify in terms of being considered infrastructure, even by the government definition. So I think most funds may have some exposure to real estate companies, but I would not consider to them to be a significant part of an infrastructure themed investment approach.
Sure, Vetri, thank you. There is one question on the auto. How does the recovery roadmap look like for auto sector on the face of continued near-term supply chain issues and rising inflation?
Yeah. So nothing to add on auto. I think Swati also mentioned, and I've also covered this in previous calls. The way we look at it, this is one of the few sectors where current volumes are running anywhere between 20 to 30% below the peak industry volumes of financial year 2019. That's a very extremely unusual situation to face. So when we look at these companies, we think of it as a very classic contrarian investment opportunity. The volumes are already running lower than trend line. There is a long-term structural growth opportunities. Margins are running below long-term levels. As volumes pick up, there will be operating leverage that will kick in. So we think all of those arguments hold good. Unfortunately, series of disruptions are continuing to play spoil sport over there. But our thought process that this is a attractive sector from the entry point of view, and given the medium-term structural opportunity, nothing has changed, and we would remain positive.
So, Vetri, thanks. I think we have already hit the scheduled time, so we can take last two questions. One question on pharma, ma'am, if you can take this. This is on the diagnostic players. We have recently witnessed the diagnostic players going through a phase of slump, some correction happening. So what are the headwinds impacting the subsector? And also the second question is, would there be delay in recovery in pharmaceutical sector despite of the push from government through PLI schemes?
Yeah, so as far as diagnostic is concerned, because of the COVID wave that we have seen, multiple waves, the diagnostic as a sector has seen a good amount of revenue growth and as well as the profitability growth. So therefore, this entire sector is sitting on a very high growth in the base. So of late, we have seen that whenever there is the worries about the COVID infection go down, that has been playing on the sentiment. But I would like to look at the larger picture as far as diagnostic is concerned. Think about underinvestments in the whole health infrastructure. Think about the chains which are contributing, the diagnostic chain. That means one particular lab is pan-India, the diagnostic company. There are regional companies, there are companies which are pan-India companies. So when I say chain, diagnostic chains, that means one particular company is all over India, they are expanding. So such chains are still contributing less than 20% as far as the overall diagnostic opportunity is concerned. That means there is a huge opportunity for consolidation in this industry. Perhaps that consolidation we have not seen in recent past, because all labs doing well in terms of the COVID related testing. It is just not the RT-PCR, but because of the infection, there are huge amount of allied tests that go through during this period, and therefore the consolidation has kind of got postponed, because the expectations of valuations that the targets are asking is much higher than what the acquiring companies would be willing to give, and they also need to be conscious about the capital allocation, which we like in the holdings that we have, that they have come out with the capital allocation decisions which are accretive in nature, and therefore this process, even if it is kind of delayed now, going forward, we think there is a huge opportunity of consolidation, huge opportunity of people spending on health, the awareness going up. These are some of the tailwinds that we see for diagnostic as a subsector. In terms of pharmaceuticals, I think the growth is clearly the chronic segment, which I said typically, unfortunately, with the lifestyle that all of us have, the onset of cardiovascular or the diabetes related diseases has been quite prevalent, and because of these the chronic ailments, the patients typically have to take drugs lifetime, unlike antibiotics, which is, you take for 7 days, 8 days, and you are done with it. So therefore, I think, and India is unfortunately called capital for diabetes also, world capital for diabetes. So that is the kind of opportunity as far as the chronic segment is concerned. And we also see great amount of opportunities in the contract manufacturing space. And of course, in the raw material side also, as the API segment also, the key, the KSMs that India depends as far as the branded formulation is concerned, the supply chain getting de-risked away from China has also thrown some opportunities for such players in India. So I think that yes, pharmaceuticals of late has not done that great, but there is a huge potential as far as this sector is concerned, and therefore we have been maintaining overweight position in this. That worked very well in 2021, but in last 1 year, I think because of the base being high for certain formulations companies, where COVID has been contributing more than 15-20% of their overall portfolio, and as the inflation go down, there is a sentimental impact on the future growth expectations, which we think that yes, near term there might be lower based on the high growth of past, but the opportunity is pretty much there when you look at next 5 years period to 10 years period.
So thanks once again, ma'am. So one last question to you, Vetri. This is a question coming from Mr. Sunil Kumar Patil and a few others. So the question is, if I-10 volatility is likely to remain in near term, so what is the ideal period for an investor? He should be looking for staggered investment for his incremental investments, and what would be the ideal levels for lump sum allocation?
Just I'd like to highlight that from a historical point of view, market volatility is not particularly high. So we have not really seen acutely high levels of market volatility. These are still fairly normal levels of market volatility. Our thought process is driven more by valuations than by volatility. Large cap valuations, certainly, as I said, they had dipped into fair value. They're still somewhere between the upper end of fair value and just entering the rich zone. So we are comfortable there. But, there is uncertainty. As I said, we are dealing with probabilities, not with certainties. And therefore, I think it makes sense to stagger the investments in the large cap space. And, you could look at staggering them over a 9 to 12 month period. In any case, when you're staggering, you have the option, if the market were to have a very adverse movement or a very favorable movement in terms of valuations, you can always review your strategy of staggering. But I would say, as of now, look at a 9 to 12 month period of staggering investments. And that also, I would say, in the large cap domain, I think the mid and small cap from a valuation point of view, still not demonstrating that kind of attractiveness.
Yeah, sure, Vetri, thanks. So participants, if you find if there are any question that was missed out answering here, so kindly be in touch with our relationship managers who will be more than happy to get your queries answered. And yeah, before I hand it over back to Vetri for concluding remarks, so just a request to the participants here today. So please use the chat box to share your feedback on the content covered today or on the quality of the webinar. So it will help us to do better in our upcoming webinars. So thanks everyone. Back to you, Vetri. Yeah.
Sure. Thank you everybody for joining us today on this monthly conference call, and thanks to Swati and Niranjan for their participation and their support through this event. We look forward to your continued engagement. We love to have your questions beforehand because it helps us tailor the webinar to meet some of the questions that are on your mind. But of course, we are also happy to take the questions as they come during the live event. Thank you once again for your time this evening, and we look forward to connecting with you again next month in May. Thank you and have a good evening.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.